Time for the latest earnings outlook now with Research Director Shiraz Mian. Shiraz, it's been a very mixed Q1 earnings season up to this point. We're a little bit past the midway point now as you and I talk here. Is mixed okay?
No, mixed is not okay.
Okay.
We have had a very impressive run in the market over the last couple of years, particularly in 2013. And a big part of those gains were in anticipation of a turnaround on the earnings side. Turnaround in the sense that for a good part of 2 years now, we've been seeing this consistent trend of estimates for the coming quarters coming down. So the revisions trend has persistently been on the negative side. The turnaround on that front will be that we need that trend to end. And we want the market's confidence in estimates for the outer period to increase, and we are not seeing that. So mixed is not enough. The market is looking for confirmation that the earnings picture it has been hoping for and looking forward to will finally arrive, and we are not seeing that.
All right, give us a quick rundown on the scorecard.
Okay, I have a chart for you. This is the scorecard table that I put out in the weekly earnings trend report. We have, as of this morning, 348 S&P 500 companies have reported results.
And that's as of May the 1st.
That's as of the morning of
May the 1st.
152 still to come.
All right.
This is 76.2% of the index's total market capitalization. So the bulk of the results are now clearly behind us. Total earnings are up 2.1% on 2.4% revenue growth. 69.1% are beating EPS estimates. 40.6% are beating revenue estimates. The growth numbers for earnings, the beat ratios for revenue are clearly on the weak side relative to what we have been seeing from these same 348 companies in Q4 and in the 4-quarter average. The EPS beat ratio is broadly in line with the historical average, so nothing really major going on that front. I have another table that gives you kind of a summary view of the S&P 500 as a whole, including the 348 and the 152 still to come. So if you look at the Q1 picture as a whole, total earnings as of today are expected to be up 0.5% on 2.3% higher revenue and modestly lower margins. So not much growth. There's not much growth. Most companies are missing revenue or top line estimates, and the overall tone on the guidance front remains the same as we have been seeing for more than a year, meaning that guidance remains negative.
Okay, so what about trends? Do you see, as a result of all of this data, any disturbing trends coming to the top here?
Yeah, the most disturbing trend, I would say, Terry, is that most of us, or those who have an optimistic view of the market and the earnings picture, we're hoping that we will start seeing some change or improvement on the guidance front. And the hope on that front had been that if the U.S. economy was on track to improve to a growth pace which was higher than what we've become accustomed to over the last few years. If Europe, as everybody acknowledges now, has stabilized, we should start seeing that in management commentary when they discuss the current period and the outer periods. We are not seeing that. And as a result of that, I have another chart I want to share with folks.
Sure.
And this shows the revisions trend that I referred to at the top which has been consistently on the negative side. So 1 month into Q2, total earnings for the second quarter of 2014 are down 1.7%. And I'm talking here the magnitude of total revision. This isn't the growth rate. This is basically comparing what total earnings were expected at the beginning of April and then what they were expected at the end of April, and they had declined 1.7%. And we have done a similar analysis for comparable periods for the preceding 5 quarters. So it is a modestly lower level of negative revision compared to what we saw in Q1. But the gray column, the 1.6% decline, that's the average of the last 5 quarters, and it's a bit on the higher side. So my sense is that as we see the rest of this earnings season unfold, this pace of negative revisions will only accelerate.
So if I'm hearing what you're saying, the Q1 earnings that have been reported so far are making a statement about our economic recovery, which has been happening in fits and starts up to now.
Yeah, the Q1 was a tough period for the economy. The Q1 was a tough period on the earnings front too. We saw that in the GDP report. All of us expected that the GDP numbers will be weak. None of us were ready for that shockingly low number. But more of the weather-sensitive, weather-exposed sectors of the on the earnings front too, we are seeing a lot of them coming out and complaining about weather, whether it's UPS, FedEx, whether it's the airlines, whether it's the consumer stocks, retailers, industrials. So we knew that weather was a factor and that Q1 would be weak. The hope was, and that seems to be getting confirmed in the economic data, and the hope was that we will see some similar confirmation on the earnings front. We are not seeing that.
Let me ask you something, and we'll have to end it with this, but there's been a lot of M&A activity so far this year, companies buying up other companies. So against that backdrop, is corporations are starting to put their money to work that way rather than stockpiling it as they have been. Is that going to be a positive for earnings going forward into the year?
It partly is. It partly, and the reason why I say that is that it's a reflection of the management team's confidence in the outlook.
Right.
So instead of paying the cash in dividends and buybacks as they have been doing now, they're starting to use that for buying growth. They cannot get growth organically. So the hope was that these companies are sitting on so much cash and they'll start investing it in their businesses, which will generate more employment in the economy and will create that cycle. But they're not seeing that opportunity, and they're instead going out on Wall Street and shopping for growth over there, and the high-priced stock prices are giving them a good currency to do that shopping.
All right, thank you for that. Don't forget, during earnings seasons, plural, all throughout the year, you can keep up on all of the trends going on with Shiraz's written earnings trends commentary. And then day to day during every earnings season, he always has comments in his Ahead of Wall Street column. All on Zacks.com. And all there for you, linkable, if that's a word, right off the homepage with Shiraz. I'm Terry Ruffalo.